In this video, I'm gonna tell you why online businesses beat traditional investments. Basically, it comes down to money in, capital gains, and valuations. So what do I mean by online businesses? A lot of people become self-employed nowadays, and those business models are often platform-based. So you can have an Instagram page, a YouTube channel, you can sell goods on Amazon, you are a freelancer, or you simply have a website which is also ranked by Google, and you can also have a software as a service which might be related to one of these several platforms. Most people on the internet only consume content and they never produce anything. So how would you invest in an online business? First of all, businesses are never forever. An YouTube channel or an Instagram page, those people are better off if they sell it forward to someone else. Amazon seller account is still worth something even if you give up the business. They don't plan to operate it forever most of the cases. That's why there are brokerage websites which allow you to sell and buy these businesses. For example, Empire Flippers or Flipper. They have several categories in which you can buy YouTube channels, Amazon seller accounts, websites, SaaS businesses, iOS apps, Android app, whatever you like. So there are different niches in which you can buy businesses, and that's the place where they are sold. In many cases, they are operated by a single person, a small team, and in most cases, the small team consists of freelancers. Why would you invest in an online business? In general, I would say the hard facts are it's an income producing asset. Valuations are really low. There are some problems with quality in some cases, but in general, there are high quality online businesses available, and even in comparison to the quality, the valuation can be really fair or even low. You can create a significant amount of capital gains depending on your strategy. In my case, I would always go for value add. And there are also soft facts you would choose to invest in an online business. So you might have a certain lifestyle in mind, and as online business would give you the opportunity to have location freedom, so you can work in the place you like to live in. Financial freedom. In general, you can scale it up as high as you want if you are that successful. Much more income than in a 9-to-5 job where you reach a certain ceiling. And of course, time freedom. In 9-to-5, you work at a certain business hours. You must be available. With an online business, you are much more free to choose when you're gonna work. This can also be a great way to build wealth. Let me give you an example. I'll give you two examples. One is Amazon FBA. This is a Empire Flippers screenshot, and there you have a Amazon FBA account which costs $1.78 million. This business generates $209,000 monthly revenue and a profit of $45,000 each month. There's a sports health fitness business. So in this niche you have certain product which they are selling. The price represents a monthly multiple of 39 times the monthly net profit. This means if you calculate it to the yearly net profit valuation, it's 3.25 net profit each year. After 3 years and a bit, you would have your return back. In percentage, this would be like 30% return cash flow, net profit cash flow in a year. This always assumes there's no room for negotiation. Of course, you have to pay taxes, but this situation is always individual. The net profit in this case and in any case is just an average of, let's say, the last 12 months, for example. If you're gonna buy this business, you're gonna earn the cash flow from the day you're gonna buy it. So you could earn more or less depending on the product, some fluctuation in general. In this case, you would need to have inventory. You can have a change in margins because the products are more expensive, or you could have also more margin. You can renegotiate the terms of the manufacturer which provides you and supplies you the products. You can do a lot to work on the net profit and also on the revenue. If you expand the product line, you can have more ads in general or more efficient ads displayed on Amazon. So you can do a lot after you bought it. If you just take the assumption it operates as the same as the time it operated before, the returns are quite high. Let me give you another example. This is an Amazon KDP business also sold on Empire Flippers. This business is different to the Amazon FBA business. In Amazon KDP you don't sell physical goods. You basically sell, it's basically a book business. You only have to take care of creating a content, so you have to create a book. You don't have any inventory. If you compare the numbers, you would have similar numbers. Let's say 3.1 times net profit each year would be the multiple, and 31% return each year. This would be in percent. The numbers are quite similar. The business fundamentals are totally different. In Amazon KDP, you don't have any inventory. If you take this business over and you pay the price, you need to buy the inventory over and over again. Of course, your revenue will provide you the cash flow in general, but still there could be some hiccups and you could run into cash flow problems. There could be more competition, less margin, and then you have to come up with enough capital to buy inventory for the Christmas season. Whatever is the case, you could run into cash flow problems. In Amazon KDP, on the other side, you don't have any inventory. In my opinion, this business model is more efficient, more lean, has less downside in general. So you have to really understand what kind of business you're going to buy. You can earn a lot of money with in each business niche, but you really have to understand the business model and specific business which is offered and their products. Let me talk a bit about value creation. In every business, there are 3 different ways in which you can create value. This applies to stock, real estate, own private business, bonds, whatever it is. It's always the same. There's only leverage. You can have a multiple expansion, which means the businesses we saw before were sold on a roughly 3 times net profit each year. If you have the same business sold for 4 times net profit each year, you would have created a value of 1 time net profit each year, which is basically 25% return. Also, you could create an operational improvement, which means if you take this one as an example, here we have $25,000 monthly revenue and $19,000 net profit. The difference between those numbers in Amazon KDP can always be attributed to the ad spend, the advertisement on Amazon. If you are able to increase the efficiency of the ads and you can create more efficient ads, so you spend less money, your net profit could increase to 21,000 or let's say 22,000. So 20,000 net profit before and 22,000 now means there's a 10% value gain in your business, because if you apply the same multiple, the price must be higher. You can read this yourself. There are always 3 different levers in which you can create value and make something worth more than it was before.
Let me give you a rough overview about traditional investments.
Don't nail me on the specific. I want to give you a broad overview on how things are in general. So let's compare them. Bonds. If you want to get rich in bonds, I gotta say you cannot get rich by that. Bonds are not made for that. They always pay you the least amount of return possible. The more safe they are, you basically don't have any return. You only get the risk-free. The returns are made on the equity side. So let's forget about bonds. Real estate is a really good option to create wealth. You have a stable income. The problem is the multiple is really high. Depending on the location where you buy the real estate and what kind of real estate you buy, the multiple is exorbitant. So if you buy real estate attractive part of London or in Switzerland, in Zurich, you're gonna pay a high multiple for the safety the real estate represents. The financial barrier to entry is really high. Basically, almost no one would buy real estate if there would be no leverage. You have to be able to pay for repairs, for renovations. So you have always like a a commitment to the long-term stability of the income. This might be easily either financeable, or it could be easily calculated for the future, but still the multiple with 20 times yearly rent is quite some money. So the equity yields are really high, but the yields on the normal price of the real estate is quite low. You can have tax benefits and it grows over time, and the equity grows in most cases if you have an attractive market. And you also have to understand, you have to really have know-how in this area, in many different areas, because real estate is simple in general, but you have to really understand a lot of technical stuff to really do it right, and you cannot get rid of it in a short amount of time. You have to really commit to it for long term. It's a good way to build wealth, I would say, even for retards, because you don't have to really understand that much. You can buy real estate in your rural area, and you can have an income which can be beneficial for you for quite a long term. But if you wouldn't have leverage or tax advantages, a lot of people would not invest in it. So stocks are an alternative. I would differentiate about different kind of stocks. In general, the S&P 500 investment, like an index fund investment, returns you like 8 to 10% return each year, and this is quite good. But if you have like a certain strategy in stocks, you have different characteristics. So let's take value stocks as an example. With value stocks, you would have a stable and high, normal or moderate and till high dividend income. So you would have, let's say, 5 to 10% return each year. If you take this number, 8 to 10%, the stock market or the S&P 500 consists of value and growth stocks, so there must be some returns below it and some returns above it to create this average. So value stock in general should be below it. I would say 5 to 10%. Of course, you can pick certain specific stocks where you have more return, but let's take this as a rough number. The multiple is lower. You don't have to have a lot of money to invest in it. The leverage is included in the company, but not attributed to you. In real estate, the leverage is bound to you, so you are responsible for the leverage. In value stocks, you can have the benefit of getting a dividend return, because the business doesn't grow that much. You have to have a return as a dividend. So you have your dividend return, let's say 2 to 5%, and you get small capital gains. And your volatility is also quite low because the business is stable. Investing in value stocks, like dividend investing, is a slower and safer way to build wealth, and it takes a lot of patience, and you trade this for slow income and capital growth. I would say that's not a good way to create wealth. You create cash flow, but your cash flow is not that significant unless you earn a lot of money each month or each year. Only after, let's say, 15 years, your dividend income will be really replace your job or can give you some financial freedom. Growth stocks on the other side return more than the average of the S&P. So let's say 12 to 20% per annum. So 20% is really good return if you can do that. I did it in the last 5 years in my stock portfolio, but that's not easy. You buy growth stocks for a much higher multiple. The same as in value stocks, your leverage is included. You don't need that much money, but you don't know if you're gonna have a dividend return. If your stock value is growing, you don't have any benefits from it besides having a larger number in your account. Also, it's more volatile. It's always a bit stressful. Sometimes you are excited and sometimes you are depressed. In my case, I think growth stocks are quite good option. You can create more wealth and in a faster way. Even you could also be lucky, but you can watch it grow, and you are rich on paper. You don't have anything you can do with it other than realizing the gains and then having it sitting there in your bank account. So there's no cash flow generation, or only minor. You can do it only by realized gain. And if you combine multiple high returns one after another, you can create a lot of money. But you have to be lucky with that and be rather stick to normal expectations. So let's say you are able to invest in private equity funds. This is another popular way, and I would say the returns are higher than in growth stocks. So 15 to 25% is certainly possible, but you have to have money. Do you need at least 1 million? Access to a certain network of investor, of private equity companies, and the best funds are not available to the common man. So you need to have, even if you have money, you would also need have to have access to the private equity companies themselves, and then be able to put some money down into their funds. That's actually really crucial in this case, because if you pick the wrong managers, you would end up risking a lot of money. The best managers close their funds, and only a few lucky ones and good connected people with a lot of money get access to it. It takes a long time, usually 5 to 10 years or even longer, and the fees are really high. But it's a good way to invest money in a less, let's say, volatile way, more stable way in which they carry out the strategies. But you have to be rich already in general. In this way, the rich people build even more wealth. You need a network that's not available for everybody. Let's summarize it. So value stocks give you, let's say, 3 to 5% cash flow through dividends, but small capital gains. Growth stocks give you significant capital gains, but actually no cash flows if you don't sell them. Real estate can give you both, but only after some time, and if you don't make mistakes. So you need know-how, and you also need quite a bit of equity, and you cannot buy London real estate from LA because the distance is way too far away. So you basically have a location-based business. You have to be in the area, you have to have the time, the know-how of the market, of the fundamentals of the building, everything. You have to be, you can be unlucky with the people who pay you the rent, but after some times earn you a significant amount of wealth. Private equity funds earn you a lot of capital gains, but you need access, capital, and time. On the other side, online businesses can earn you both. They can earn you a significant cash flow and capital gains on the same time. But you need the specific know-how and capital, but not as much as in real estate or private equity. Why is it superior? Online businesses are sold in a less liquid market, but there is a market. So there is a market for YouTube channels, for Amazon FBA, for Amazon KDP businesses, for Instagram accounts. It's less liquid, it's more risky. So there's a high uncertainty. This means you get an exceptional high risk premium. So the valuations are very low. In general, I would say 2 to 5 times yearly cash flow. Usually, I would say 2 to 4, maybe 3 times, depending on the quality, of course. So you can create significant cash flows with this. You can increase or decrease them depending on your strategy. You can also be unlucky, but you can increase or decrease them. If you know about the business, you can react to certain different scenarios. In this way, you can increase or decrease capital gains because you will sell it on, and you have to have a plan to increase the value of the business, to increase the capital gains. If you increase the cash flow of a YouTube channel by 10% to create more ad revenue, you have to create more videos, for example. And you don't have to do it yourself. You could have a team which was already there before, which creates the videos for you. If you have a plan, you can increase the cash flow by 10% and therefore increase the capital gain by 10% in the same amount if you're gonna sell it for the same multiple. And even if you keep everything the same, you can sell it for a higher multiple at the exit or a lower multiple. Both could be the case, but it's always beneficial to create more cash flow. Therefore, you need know-how, you need capital, but not a lot. I mean, a lot is subjective, but you don't need millions in general. And you also need speed. Speed is crucial in business. The margin of error is much higher compared to the other asset categories. You also have the opportunity to reinvest the cash flows. So once you buy the business, your cash flow will not try out of the sudden. If you do your due diligence, it will go on for some time and you will have time to react. But it will be volatile, so it won't be the same as a bond or as a dividend stock. So you have to keep it stable, and if you keep it stable, you will outperform the other wealth generation methods or the other asset categories. If you increase it on the other side, your wealth will grow exponentially. So let me give you an example. Let's say you have $100,000 to invest and you're gonna buy an Amazon KDP account. You buy it for 3 times yearly cash flow. This means you would have a cash flow of $2,700 each month on average and a yearly cash flow of $33,000 each year. In the first scenario, you would create a 20% profit after 1 year. You're gonna sell it for $120,000. This means you earn $33,000 plus $20,000. You earn $53,000 and you have $153,000 now. So you have a return of 53%. If you sell it for $90,000 after a year, you lost $10,000, but you still earned $33,000 of cash flow. Still, you would be 23% in the green. This is what I mean. The margin of error is higher. You're still buying a productive asset, which gives you quite a bit of cash flow each month. Just imagine what you could do in 1 year if you stay consistent and create more quality content for this business, create more opportunities to make more money for the future. So what about the risk? The risk is manageable. It's not like it's a roulette table or it's a casino. It's not that. You have to really understand the business model in which you are going to buy the business. You really have to understand the niche in what products are in the business. You really have to maybe even buy the products. You have to test them. You have to have knowledge about the subject. You have to manage your risk. This is key. So you have to learn the specific business niche, and after some time you're gonna learn to differentiate the quality of the deal. It's always a deal. So if you're gonna look at an apartment each day and you're gonna do it every single day for the next 3 years, after 3 years you would be an expert in apartments. So you would have a real good understanding if this deal is a good deal. And if you do the same with those online businesses and learn about it for quite some time, you're gonna have a good feeling about the deal quality which is presented to you. The risk is also not that high if you understand that the business has already sold products to customers in the past. So there's a track record. There are profits and revenues. In almost all cases, the online business is already profitable. So you have a track record and you have products which are already were sold. And that's the hardest part. The hardest part is done. You have to find a product which sells, a product which you can differentiate, where you can create new products. And if you expand that, you can create more value, or you can soften the decline of the revenues in the future. You have to do value add, as I said. You have to expand the business in the time, and this will give you a lot of capital gains in the future. Because if you succeed, at least modestly, you will outperform other investment categories and you would be able to change your lifestyle. You would simply be able to live in a better place. You can travel the world while you're running your business. You can have a lifestyle which is really beneficial to your personal life. If you understand my ideas, you can subscribe. If you don't and don't like it, just don't. Leave a comment if you have any specific questions, and yeah, have a great day. Ciao.